Well, my next guest says that the good times have continued to roll for our economy, but there have been enough signs of strength maybe to disappoint investors who are looking for a whole lot of rate cuts beginning in May. I want to bring in now J.P. Morgan Asset Management, their fixed income portfolio manager, Kelsey Berro. Kelsey, let's start with this on this Friday revision thing. I was so confused because it was like ominous, like, oh man, everyone's like, come to work in a hard hat. And it felt like a non-event. And I'm looking at the revisions for all of last year, and I don't even see why it was an event to begin with, why we were so afraid of this number coming in.
Right. So there was a fear about the inflation revisions because of what happened last year, which was there were large upward revisions. So it looked like the Fed was making a lot of progress last year, and then that progress was set back by revisions. This year, we all breathed a sigh of relief. My Friday was not ruined.
Right.
The trend, the disinflationary trend, remains intact, and now all eyes are on the CPI report tomorrow.
When this whole rate hiking cycle began, we were told to look for certain metrics, right? Certain markers of progress. One was financial conditions. Mm-hmm. Well, financial conditions are easier now than when the Fed began. We were told a lot of things were going to break. I'm not sure exactly what broke, but we were told a whole lot of things were going to break, including maybe 2 million additional people unemployed, a broken housing market. So all of the things that we were told to brace for, that Jay Powell and others told us to brace for, haven't really come to fruition. And I'm wondering, has the whole thing been an exercise in futility?
So I don't think it's been an exercise in futility. You are correct. The economy is extremely strong. The good times continue to roll. We've had 26 months in a row where the unemployment rate has been at or below 4%. You haven't seen that since the 1960s. But there has been impacts of the Fed tightening policy. They hiked at the fastest rate, the largest increment in multiple decades. And the biggest response you saw was in the banking sector. Bank lending has declined.
Right.
Credit conditions has tightened. And it
Right.
does depend on which metric you use.
Right.
Financial conditions are accommodative in some measures, but they're not necessarily accommodative in all measures. For example, you don't see a lot of mortgage applications today. That's because this level of mortgage rates is quite unaffordable for most Americans, and that is putting downward pressure on the housing market. Existing home sales, very low.
But home prices themselves, they've come down, but they haven't broken. I guess there's an anomaly there because of how many people actually have low mortgages. I don't think anyone really figured out, wow, there would be no need to sell your house, or you wouldn't want to sell your house in exchange for a 2.5% mortgage for a 7.5% mortgage. So maybe that's created some kind of unique anomaly there.
Well, so to go back to what the Fed accomplished was maintaining their credibility. They started hiking rates too late, and we all saw that.
Sure.
And we saw inflation expectations start to get unanchored. The Fed's ultimate goal is price stability. If everybody is talking about prices and how fast prices are going up, then the Fed isn't doing their job. The New York Fed does a survey of consumers. It just came out this morning. Inflation expectations in that measure, which is 3 years forward, that's at the lowest rate it's been since 2012. So what the Fed has really accomplished, inflation has come down, but the consumer is also more comfortable that the future inflation environment is going to be one that's more normal, and we're not going to have a repeat of what we had 24 months ago.
But could the flip side of that be a comfortable consumer with the stock market at all-time highs, home prices relatively high, certainly compared to the last, if you've owned your home for 5 or 10 years, the wealth effect? Couldn't all this work against the Fed in the first place? I mean, the street's still looking for 6 rate cuts. I know you're looking at June, the street's looking at May. I mean, it just feels like if the Fed went through with 6 rate cuts, would they be ignoring the wealth effect, and would they actually exacerbate it?
So here's the thing. I think people are focusing way too much on when the Fed is going to start cutting and exactly how many rate cuts that are going to be delivered this year. So yes, we think the Fed will be cutting rates this year. It should happen by June. But the secret is there is $6 trillion in money market funds right now. That's earning a rate that looks really good. That cash rate is going to go away. You only get 5% on your money market fund if the Fed keeps rates unchanged for the next 12 months. If not, that 3-month T-bill, you keep rolling that over and rolling that over. You're going to be rolling it over at lower rates. Ultimately, in every cycle you look back,
Right.
when the Fed stops hiking, fixed income is going to outperform cash. So our focus right now is to get people out of cash and get their money working for them and locking in those yields, not just for the next 3 or 6 months, but for a longer period of time.
All right, so bonds are the way to go.
Yes?
All right. Thank you, Kelsey. Appreciate it.